Hi, I'm Albert Matusek with the Princeton Review, and today I'm going to talk about the factors that influence the price of gold.
Why gold matters. From ancient civilizations to the modern era, gold has been one of the world's currencies of choice. As societies developed, gold was universally accepted as a satisfactory form of payment. Today, the US monetary system is based on paper money backed by the full faith and credit of the federal government. The currency is neither valued in, backed by, or officially convertible into gold. Through much of its history, however, the United States uses a gold standard. Gold coins were first used on the order of King Croesus in an area that is now part of Turkey, around 550 BC. The gold coins circulated as currency in many countries before the introduction of paper money. Once paper money was introduced, currencies still maintained an explicit link to gold, the paper being exchangeable for gold on demand. By the late 19th century, many of the world's major currencies were fixed to gold at a set price per ounce under the gold standard, and this persisted in different forms for about 100 years. Despite several attempts to retain some link to gold, all official links to the gold of the dollar to gold ended in 1976. Now let's talk about the factors that affect the price of gold. But before we do that, let's talk about gold's intrinsic value. Does it have an intrinsic or fundamental value? The intrinsic value of an asset is a function of its expected future cash flows, growth, and risk. Since gold is a non-cash flow generating asset, it's difficult to estimate an intrinsic value for gold. It's the same argument you can make about all collectibles, whether it's a Picasso or hockey cards. If one of the central tenets of value investing is that you should never invest in an asset without estimating its value, that would seem to rule out gold as an investment, particularly for a classic value investor. In fact, investment guru Warren Buffett has repeatedly argued against investing in gold because its value is difficult to estimate. Warren Buffett made waves when he bought around $565 million in Barrick gold stock in Q2 2020, but he soon exited the gold position altogether by the end of the same year. But investing in Barrick Gold is not really investing in gold because it's a mining company with assets and cash flows, and it mines other precious metals, not just gold. So in the next slides to come, we'll talk about all the factors that affect the price of gold. These include supply and demand for gold, interest rates, inflation rates, currency movements, and economic data. So the first factor that affects the price of gold is the supply and demand of gold. Increased demand for gold with low supply has the tendency of pulling a commodity such as gold prices higher. Conversely, an oversupply of gold with weak demand will drive the price of gold lower. Using supply and demand, however, to value gold has its shortcomings. While using supply and demand to value gold may work, at least in principle, for industrial commodities, it's tough to put into practice with precious metals in general, such as gold in particular, because the demand is not driven primarily by practical uses. Another factor affecting the price of gold is the inflation rate. Inflation, or the rising price of goods and services, can certainly impact gold prices. Rising or higher levels of inflation tend to push the price of gold higher, whereas lower levels of inflation lower the price of gold. Increasing the money supply faster than the growth in real output will cause inflation. The reason is that there is more money chasing the same number of goods. Therefore, the increase in monetary demand causes firms to push up prices. So, increasing the money supply dilutes the value of each existing monetary note in circulation, making it more expensive to buy assets that are a perceived store of value, such as gold. In other words, increasing the money supply drives up the price of gold. So let's work through an example. If the dollar loses value from the effects of inflation, gold tends to become more expensive. So an owner of gold is protected or hedged against a falling dollar because as inflation rises and erodes the value of the dollar, the cost of every ounce of gold in dollars will rise as a result. So the investor is compensated for this inflation with more dollars for each ounce of gold. So this is why there is a widely held view of gold that it is a hedge against inflation. We can see this relationship in this graph that plots the price of gold and the US monetary supply, and it shows that it has a positive correlation. Increasing the money supply dilutes the value of each existing monetary note in circulation, making it more expensive to buy assets that are a perceived store of value, such as gold. Another factor affecting the price of gold are currency movements. So the price of gold is dollar denominated, making the US dollar a strong influencer of gold prices. A depreciating US dollar tends to push the gold price higher as other currencies and commodities around the world increase in value when the dollar depreciates. All else being equal, price of gold is generally inversely related to the value of the US dollar, thus making the gold price lower when the US dollar appreciates against other currencies. If we plot the gold price, shown here in orange, against the US dollar index, you can see that this is indeed the case, as they tend to have a negative correlation. So, when the value of the dollar increases relative to other currencies around the world, the price of gold tends to fall in US dollar terms. Conversely, as the value of the US dollar moves lower, gold tends to appreciate as it becomes cheaper in other currencies. The last factor that we'll talk about that affects the price of gold is economic data. There is a psychological factor attached to the value of gold. The price of gold is often sensitive to the overall perceived value of paper currencies. During times of fear or geopolitical turmoil, the price of the historic metal tends to rise as faith in government falls. During times of calm, the price of gold tends to fall. As perhaps the world's oldest and most storied currency, gold is an important barometer in terms of global economic and political well-being. Economic data, such as jobs reports, wage data, and other broad-based macroeconomic data, such as GDP, influence the Fed's monetary decision, which in turn affects the price of gold. A strong economy, as indicated by the economic data, usually implies that monetary policies could be tightened by increasing interest rates, which lead to a decrease in gold prices. Meanwhile, a weak economy usually leads to contractionary monetary policies, thereby reducing interest rates and increasing the price of gold.
So in summary, there are a number of factors that affect the price of gold. Number one, increased demand for gold with low supply has a tendency of pulling commodity prices higher. Conversely, an oversupply of gold with weak demand will drive the price lower. Number two, lower interest rates make gold an attractive investment opportunity because the opportunity cost of foregoing interest-based assets is low. However, when interest rates rise, investors will be less likely to invest in gold and instead invest in assets that yield a higher rate of return due to the rising rates. Number three, rising or higher levels of inflation tend to push gold prices higher, whereas lower levels of inflation tend to lower the price of gold. So in periods of inflation, it dilutes the value of each existing monetary note in circulation, making it more expensive to buy assets that are a perceived store of value such as gold. Number four, a depreciating US dollar tends to push gold prices higher, as other currencies and commodities around the world increase in value when the dollar depreciates. And number five, economic data. A strong economy, as indicated by economic data, usually implies that monetary policy could be tightened by increasing interest rates, thus leading to a decrease in gold prices. Meanwhile, a weak economy usually leads to a contractionary monetary policy, thereby reducing interest rates and increasing gold prices.